for taking the time.
Yeah, man, absolutely. Much appreciated.
I think we should be live now. Give it 1 second,
Yeah, man.
and then we can get rolling. Um, so basically, I guess we can just start off with like sort of an introduction, I guess.
Yeah.
Just tell us a little bit about yourself. Yeah.
Sure. Yeah. So I've been pretty much part of the same community as you, but obviously people come in and out and also join all the time. So I'm Matt Farley, and 30-year-old investor. Been investing since about 2012, 2013 timeframe. Working oil and gas as a petroleum engineer by education, and mostly just invest in equities. Continue to buy every damn month, every time I get a paycheck. And then I dabble in some other things, like I do crypto NFTs for a small portion of my portfolio, but easily over 95% of my portfolio is in equities. So we could talk about whatever, man. But yeah, that's to give people the rundown. And then I also, I guess, on my nighttime job, love to help people out like yourself from an investing standpoint, whether that's trying to get them started or just discussing stocks in general. I'd love to do both. So yeah, but at nighttime, that's generally what I'm doing, whether that's in a Discord or whether that's on Twitter or whether that's on Facebook or YouTube or whatever. So that's a little bit of a rundown about me.
Yeah. So I guess what got you like into investing? What kind of started that out for you?
Uh, I come from a background where a lot of people invested in real estate. So
Okay.
a lot of my family was very much real estate focused, and I saw the work that went into that. And there's nothing wrong with real estate. I just think it's depending on how you want to live your life and how active and passive you want to be. There's definitely great ways to make money in real estate. It's just I wanted to do something a little bit more conventional, which was get an engineering degree and then, be a little bit more hands off with some of my investments. So I still wanted to invest. I saw how lucrative it was to invest. I saw how prudent it was as a young person to invest early on. Although nobody really told me, I kind of just figured it out through my environment and recognized that what's an easier way is the stock market and investing in equities. So that's kind of the path that I kind of headed down, and got chastised by a lot of my family because they're all thinking the stock market is all, I guess, smoke and mirrors. And the past month has showed us that it is. No, I'm just kidding. But no, but yeah. So I think that I've done really well with it, and now it's gotten to the place where I feel like I can take my foot off the gas a little bit and maybe start focusing on other things like real estate to be able to help with leverage and stuff of the like that would be prudent if you have a firm foundation.
Yeah, that's kind of like my, I guess, thing I'm thinking about recently is like real estate because it's something that's like interesting to me, and some of my family has been involved in it, and so it's definitely like something I'm trying to consider, but at the same time, like that sort of the time factor and the um, investment factor in the sense that it's kind of like more of like a big upfront investment. You can't just like add a little bit over time, sort of.
Mm-hmm.
Um,
It's very
that's kind of
illiquid. Yeah, very
yeah,
illiquid.
that as well.
So yeah, I hear you, but you have like I agree with you. First and foremost, you have years like you had in 2020 going into 2021 where like house prices skyrocket year over year by 20-25%. And yes, they will come down, right? With interest rates, for mortgages going above 5%. Obviously, it's going to put huge pressures on people, one, applying for mortgages, and secondarily, people looking for homes because now they can only afford, let's say, $200-$300 less a month if they were to say go for the same value house, right? So it's going to put pressures for sure on it. But I don't think you're going to see house prices completely come back to where they were 2019, 2020 as well. So
Yeah.
I think it'll be interesting. I think if you have time on your side, which you and I both do, I've seen literally phenomenal things happen where you buy a house, the value of the house goes up 10x over the course of 30, 40 years. Um, and now you're basically renting it out what you bought it for 30, 40 years ago. That's a prime example of my dad's first house. He bought it and bought it for like $25,000. The annual rent on it now is close to $28,000. So it's
That's
like
crazy.
you start to think like he bought that house in '78, right? So that's I'm not good with math, so you can punish me, but that's like 45 years ago.
Yeah.
And that just kind of goes to show you like what real estate can do over the course of 10, 20 years. But then you also have examples like Detroit where the economy isn't doing as well in that area and people will move out, but Detroit's doing better as of recent. But 2008 to 2015 was not very forgiving for Detroit.
Yeah. Yeah, those are all interesting things to think about. And I guess at this point I'm like I would say I know some stuff, but I would definitely like continue learning a lot more before I actually like got involved.
Oh man, I know nothing,
Yeah.
period, ever. So I'm literally just flying by the seat of my pants and um, trying to do as good as I can.
Yeah, that's a fair point. All right, so like um I guess I sort of know a little bit about your investments, but what are your main like equity investments look like, and how do you kind of pick those? Like, what is your strategy there?
So I'm mostly a buy and hold long term sort of focus kind of guy. But that's not to say I don't dabble in growth. And it's been more of a recent thing where I was more dividend focused probably 2.5, 3 years ago. And with like everybody, I made prudent investments in growth. So I didn't go into the super speculative companies in huge masses like a lot of other people did. But I did have my few conviction plays that were 1 to 2% of the portfolio. Nothing too much to write home about. But I'd still base a majority of my investments on value plays and the S&P 500 as of late. So big plays or big positions that I have in the portfolio right now. Still a lot of oil, which I need to offload a little bit if oil continues to do well. But I think 1Q, this is my thought, 1Q. So I think Friday, Exxon and Chevron report. And then I think next week, Shell and BP report. I think it's going to be tough for the big guys, which is where the majority of my money is because I work for one of them. But I don't get a lot of shares from them. I take the money and I buy into other companies. But I'd say biggest positions outside of ETFs, which is like the S&P 500 mostly, which is about 20 to 25% of my portfolio, the S&P 500, or very close to S&P 500 products. Realty Income's up there. Depending on the day, Palantir can be up there about 3 to 4% of the portfolio. Shell's up there with about 5% of the portfolio. Realty Income's up there, yeah. Stag is up there ish. Exxon is up there with like 3.5% of the portfolio. Altria Group's up there, but maybe not to the extent of say some of the others. Might be like 2.5 to 3% of the portfolio. So you have some pretty big ones. Oh, Johnson and Johnson and Pepsi as well. J&J, I have about 200 or so shares. So that's close to 35,000, and then Pepsi I have also about 200 or so shares, and I think that was 175. So
Yeah.
about 35,000 there. So another 3.5% of the portfolio there. Yeah.
How many positions do you own, like approximately?
It's really shrunk down. Like I used to like I go through periods, I'll just be blunt. Periods of like expansion of portfolio positions and then contraction.
Okay.
And I'd say recently I've been in more of a contraction area period where it's like, for example, The thing that it's starting to kind of hit on me more, and it didn't used to, was the massive portfolio swings that I have. So obviously the market's been very volatile in 2021 and 2022. But when you get to the portfolio size that, I guess as you get older and mature, the portfolio swings start to like weigh on you a little bit heavier. So like, I'll just be blunt, opened up how much I was down yesterday. Yesterday was a pretty rough day in the market, and unrealized I didn't really do too much like profit taking or anything yesterday. I was down $28,000. So like, that's like, I've become trained to not freak out when that
Yeah.
happens, but even still, that's like, you know, almost a couple months of my salary, right? So like that
Yeah.
starts to freak you out a little bit if you actually think about it. And that I think can be somewhat eliminated by investing in the S&P. Like the S&P 500 was down for sure yesterday, but it
Yeah.
wasn't down as much as Google was. Like Google
Yeah.
overall, and Google opened up again horrible today. Like Google over the past 2-3 days is down probably 8.5, maybe even up to 10%. I don't know, but Google has been down, right? And
Yeah.
I think that other positions of the portfolio have been flat to up because they're consumer staples. And so I think just investing in the S&P and not necessarily focusing too much on continuing to grow massively through whether it's growth investing or what have you, I think investing in the S&P can kind of flatten you out because it's made that way by design, right? It's
Yeah.
made by having great profitable companies, ones that haven't lost an EPS, have a non-negative EPS for the last trailing 12 months as well as over the past 4 quarters. So yeah, it's like an actively managed mutual fund, except it's just based off of rules. So anyway, I think it just helps a little bit with having that where you have down days with Google, but you're also offset partially, if not wholly, by Altria Group going up, or Pepsi, or Coca Cola, because they've had phenomenal earnings reports this year, or this quarter rather. So
Yeah.
it kind of can help even out in that respect. And there's always going to be ebbs and flows, right? I mean, the market's just riddled with it, right? Business cycles do really well. At the end of business cycles, you don't want to be in technology. You want to be in energy. The very beginning of business cycles, you want to be investing in technology and not energy, right? So you kind of understand a little bit about, depending on where you are in the business cycle, invest in the S&P. Well, yes, it'll go up and down with business cycles. Kind of helps offset each other of money moving in and out of one sector and going into the other.
Yeah, that makes sense. Yeah, I've been like getting like notifications for like Coca Cola. Like literally the last 3 days, it'll be like all time high, all time high, all time high.
I just can't
I
believe it,
just
man.
think that's
Like
funny.
I
Yeah,
saw a lot of people putting price targets of like over $70, and I'm like, man. Which, to be very blunt, I still think that Pepsi and Coca Cola are overvalued here, but I see the value in having very stable cash flows versus maybe what's kind of going on in the tech industry right now, which is a
yeah,
little less, I guess, stable.
yeah. Well, the thing with Coke is like they didn't really recover from to like March 2020 levels or like beginning of 2020 until like the few months ago, where Pepsi got there like pretty quick. If
Yeah,
that makes sense.
yeah, dude.
Okay. So I thought that was like, I guess, good to see that they're doing better, but I would say it's a bit of a high price as well at this point. Um, so what is like what kind of things do you look at when you actually like are going to like buy a stock, I guess? Like, are you mainly buying just whatever you think is at a good value at the right time, or are you kind of like averaging into lots of positions just on a regular basis?
It really depends. Like if it's something that I've had my eye on and I really want to go heavy in for the long term, it's something where, which have I made any of those like big since like September of 2020? I don't think I've made like a very large initiation of a position, um, which was Palantir. But what I generally will do is I'll want to grow, if I were to hold on to a position for the long term, a position to about 5% of the portfolio. And that's just because it makes me feel comfortable. Like, to just be very blunt, it used to be a $10,000 position. Then it used to be a $20,000 position. And I think it's always been around 5% of the portfolio. And that's just kind of made me feel better. Some people say don't ever have anything larger than a 3. Some people don't have anything larger than 10. I just feel comfortable with 5. I feel like it's never scared me too much in times where I've had a 5% position go drastically the one way that I didn't want it to go, which was down. But I also feel like my 5% positions don't moon out of anywhere and become like 50% of the portfolio overnight, right? So I'm just comfortable with 5. So that to me is about a $50,000 position. So if I were to say initiate something else, I'd likely sell out of something else that I've either thought has become fully valued. Like right now, although Caterpillar's done really well, and it makes me think about whether or not I actually want to sell it. And same thing with Pepsi, which has done really well, but also is overvalued in my opinion at this point. I would sell out of something like that and have cash just sitting there or in the S&P 500 to say, okay, let me take some of this S&P 500 money or this cash and invest it into this position and grow it to, say, 5% if I plan on holding it for long term. I also don't mind throwing 1 to 2% positions or funds into something I want to grow into 1 to 2% if it's going to be a swing trade. It's kind of what I did with Caterpillar, but then Caterpillar kind of ended up being a longer term hold in the portfolio. But I still might. I don't know. I like Caterpillar, but the problem that I'm starting with now is, like I mentioned earlier, the volatility swings bother me a shit ton, or starting to bother me a shit ton. And I'm like, okay, if I sold some of these positions, would I just in the long term be better investing in, say, the S&P 500? Knowing that, who knows what's going to happen with this individual company 5-10 years down the road, I'd be buffered by, say, investing in the S&P. So anyway, going back to kind of what you asked me, if it's a swing position, I'll generally find something that is extremely out of favor. And what I mean by that is you look at, generally speaking, prime example, 2018, 2019 market, or at least the past 12 years before kind of the COVID, the pandemic sort of issues happening, the market was kind of going up and to the right, if not flat. And then you'd have certain companies that kind of just retrace, right? And I think that's as part of the business cycle, or big companies moving out of that position. They've made their money, so they're selling out and then putting that money elsewhere. So Caterpillar, for example, was this prime. I saw it dip into like the low 120s, 110s. And I was like, it's Caterpillar, right? Like people are always going to need these big, large pieces of equipment to be able to continue to construct, mine. And I just didn't see the company going anywhere, and it had really good fundamentals. And so I said, okay, well, let me load into it. So over time, I bought 100 shares, which at the time was a lot of money for me. $10,000, just a couple of years ago was a lot of money, and it still is to respect. And I was like, this will be a good, decent swing trade. And I thought about selling it, but now it's kind of become a position where I'm like, well, I know it's kind of got a floor to it because of the infrastructure bills that are happening, coupled with you always kind of want to be in towards the end of a business cycle, kind of construct like mining kind of companies, and this kind of helps support the mining industry. So it's like, I think it's a decent company, but I think it's somewhat fully valued, not overvalued, but fully valued. And part of me just thinks in the long term. So there's the swing trades, and then there's like the Palantirs, for example, where I just know every time it drops, I'm just going to continue to buy more until something fundamentally with the company changes. Palantir is a little bit different though, because it's a long-term growth play versus what I'm used to, which is more value kind of companies. Um, but Palantir, it's like I have high conviction, and I work with Palantir every day. So at my job, we use Palantir to help with our business. So worked with them steadily since 2015, 2016 timeframe, so almost 6 years, and just grew to love the business and was like, you know what? I see the full potential that this company could grow into other markets, other companies, other industries, which they have done really well. And so when 2020 came around, I was like, I'm investing, right? I'm not just going to be a stakeholder in their success. I'm going to be a shareholder in their success. And I honestly think it'll be the next Microsoft, if not close to it. I think it'll be $1 trillion company one day. So that's a little bit different. But normally, like a Pepsi, for example, it was like, I need something that's stable and has good dividends. And you have times where it pulls back for no reason, just kind of seems out of favor, and you get the opportunity to pick it up at decent prices. And March 2020 allowed for a lot of that for my current portfolio, where I was selling out of a lot of different things and just kind of moving money around. And also the portfolio back then was about a third of the size that it is today. So, I was able to add a lot of money into it, and was taking profits in some things that I didn't like anymore, which was a lot of energy, and then moving it into these companies. But then the pandemic happened, and I was just investing as much, whether it was $5,000 a month or whatever, into some of these companies. A lot of them during that time was banks, because they were a little bit out of favor. Everyone was selling out of oil. I was buying in. Because at the time, everybody thought EVs were the way to go. And I was like, I get it. Long term, EVs will do well. But my thought process was, everyone was acting like we're never going to make or demand 100 million barrels of oil a day again. I work in oil and gas. We weren't stopping production, and we were still selling our products. So I just kind of looked at it as an opportunity. Was it a gamble? Of course, as everything is. But I just felt firmly convicted that oil was going to do well. But anyway, I've kind of diverged from your question, but I think I've answered some of
No,
it within there.
I think you answered it very well.
Yeah.
Yeah, something like sometimes I'm trying to. There's like companies that I want to own more of, and I want it to be a bigger part of my portfolio. But it's just like just keeps it's always sitting up there like out of range, of where I think it should be at, or where I would want to buy it at, and so I'm just kind of sitting there. And I mean, I think some of my issue there is just like I haven't been investing, many years, just like a few years, so it's almost sort of just like a patience thing, I think, to some degree, because um, haven't been around long enough to be able to like experience like good deals without like a market crash. Like obviously, I was there in like 2020, and everything was on sale basically, but since then, like there's a lot of stuff that hasn't been for a while. Well, there's been some stuff, but
I
there's
think,
definitely been some good
yeah,
opportunities
I
since then.
think the thing that always bothered me was like the thing that I found first was like dividend investing, right? And so I was like, okay, it always has to be about dividends. And to an extent, I think it did me well and was a stepping stone and a firm foundation to where I wanted to kind of get. But then what I recognized was, and as I learned more, this is honestly one of the reasons why I suggest people just invest in the S&P 500, but because you get a combination of all of it. But I started to recognize it's like, oh, well, you can't value a REIT, a real estate investment trust, like you can evaluate, let's just say, Coca Cola, or you can't evaluate say, a master limited partnership the same way that you value Pepsi. And the thing that bothered me the most was I was looking for companies that were trading below a 15 times price to earnings, and in return, I missed out on a lot of phenomenal companies. And I think what the big thing I was missing was I was like, okay, Warren does it kind of this way, the value investor and yada yada yada. But at the same time, it's like you have to recognize that paying something that might have a 25 times price to earnings is not a bad thing, depending on the environment, depending on how fast they're growing, and depending on what kind of business that they're in. To be honest, Pepsi alone, it trades at over a 30 PE right now, but Pepsi alone, in my opinion, is a premium business, and is with that should be awarded a 20 to 22 times multiple, not a 15.
Yeah.
And same thing with Coca Cola. Like, you have these premier businesses that, because they're premium, deserve that premium valuation of, say, 22 times price to earnings without any question. I'd say Google, if it wasn't growing, is also the same. So now that you know that Google, for example, year over year grew revenue by 30%, you start to think, wow, they grew it by 30%, and operating income grew by about over 20% as well, not from investments. So this is like X, investments, because the headline would show Google lost money compared to last year, or went down in income versus last year. And that's all based off of mark-to-market accounting and stuff of the like. But top line number and operating income numbers both went up above 20%. It's okay to invest in Google when it's trading in the high 20s price to earnings, especially if they're going to continue at the pace that they are. So, and same thing if you think about Apple and Microsoft. It's like Microsoft, in my opinion, doesn't deserve a 40 multiple, but it probably deserves a high 20s, right? And
Yeah.
because they're growing like crazy, as you probably saw in their earnings report. And same thing with Apple. Like, Apple, if they continue to grow, deserves a premium multiple of 20 to 25. I don't think it deserves to be in the high 20s, low 30s, which I think, I don't know, maybe with the recent pullbacks, it's below the 30s now, but it gives you thought. And same thing with Shopify, right? Shopify, in my opinion, should not be trading this cheap. It's going to have a continuation of being able to grow. And in my opinion, 10 years down the road, it's going to be way more expensive than it is now, and it's going to be churning out way more cash than it is now. So it's just about understanding where businesses are heading. And I think where people got in trouble in 2020 and 2021 is they threw almost all these valuations at all out the window. And they were okay with paying for EV companies that, in terms of market capitalization, were bigger than Ford and GM. And look where they are now. They're coming down in price, one. And two, I think everyone's just convinced that Ford and GM and Mercedes and Volkswagen and all those companies aren't years away from, or they're like decades away from having electric vehicles. Like, no, they're coming out now. Like, a lot of these companies are bringing out cars now, and by 2024 timeframe, we'll have multiple, if not dozens of electric vehicles out on the road, which is really going to put an impact and ceiling, in my opinion, on a lot of those EV-only companies, except for maybe Tesla. But even still, Tesla, in my opinion, is overvalued.
Yeah. I think I definitely agree on like the car auto companies, I guess. Like, they're not just gonna sit there and like roll over. Like, they definitely got things going on. And I mean, I think Chevy, and I don't know, maybe it was a few months ago, announced their like truck as well. So
Yeah, the Silverado. Yeah.
electric. But yeah, I think that it's definitely an interesting thing, like the whole Tesla thing, because like they certainly do have a lot of more room to grow, but it's it's only a matter of time before they start catching up, and especially with I'm sure like Elon is not as I guess like necessary now, but he's definitely having his attention split more and more these days, I would say. So that's something that I think about a little bit, I guess, in terms of Tesla.
For sure. So what about you? What's Hot Frank investing in these days? What's the
Um,
topic for Hot Frank?
well, recently I've been getting back into, well, not getting back into, but like buying banks, I guess. Mostly just JP Morgan. I bought some recently. They've been
Is it back
like,
into the 120s or?
yeah, they're at like 52-week lows right now,
I might
which
have
I
to
mean
look.
isn't like, yeah, it's like 122 or something.
Okay, that's a good price. Yeah, I
Yeah.
was back in March, late mid March or whatever, before we had this recent run up, and then obviously now we're back down. I was looking at banks as well, and I was like, damn. Knowing how much I want to invest in JP Morgan, I would love it to go back. I bought 100 shares of JP Morgan during the pandemic for about $88 was my cost basis at the end of it. Um, and man, I'd love to still own those shares, but it just didn't make sense, and I was too overvalued in financials at that point. I had too much Wells Fargo, and I just wanted to de-risk a little bit. And now I'm seeing where banks are right now, and it makes me want to start nibbling again, like you said,
Yeah.
because I think I'm very underweight in financials.
Yeah. Do you like pay attention to that? Because I like honestly don't really pay attention to sectors like all that much, at least as like weightings.
Well, let me tell you. No, I'm just kidding.
Like I pay attention to it, but I don't really like base my decisions that much on it.
it's a it's an I don't want to say it's an afterthought, but as a portfolio manager, I've begun to. I didn't initially, and then I started to really check it probably in the 2016 timeframe, and I recognized that over 40% of my portfolio was energy stocks, and that's about the same time I recognized that I was severely underperforming the S&P 500. And that was around the same time that energy stocks were just not doing well. I mean, oil was down comparatively, from 2014 to 2013 when I first started buying some of these companies. And it just made me kind of realize, like, holy crap, like if energy stays this way for multiple years, I'm really going to underperform the market. And so I'm a spreadsheet nerd. It's literally what I do 24/7 is spreadsheets. I'm an engineer, so and I track oil and gas production and all that. So I just use a crap ton of spreadsheets, and I started to learn a little bit about how to do some internet scraping of like web scraping of like FinViz and that stuff. And so I literally just have what is it, the chartmaster.com. I have a website where I sell spreadsheets, and it's actually pretty lucrative business. I should actually probably advertise for it, make some more moolah, but basically it tracks it on your behalf. So it reads what sector it's in off the internet. It reads, just based off the ticker symbol, and allows you to kind of track it. And it isn't that big of a deal if you just have a couple stocks and it's a small portfolio. But if you actually get to the place where you're like managing several $100,000 across 10, 15, 20 positions, it might be prudent to understand, are you over diversified into X, Y, and Z? And in an environment like we are today, with interest rates rising and stuff like that, it might be a good idea to pick up some banks because they might be able to charge a little bit more for the interest rates that they have, right? So you kind of start thinking about things like that. Granted, that is should be cautious based off the fact that, is it the best time to be investing in banks with, are people going to start foreclosing on homes and everything with, so there's a whole bunch of different things that you could go down. But you start thinking like, oh, wow, oil's really cheap right now. A lot of companies are doing really poorly. Everybody's selling out. What's my energy position? And it's like, well, I don't have any oil. So it's like, okay, well, let me add some money into oil because you obviously want to buy things when it's low and hopefully it kind of rebounds. So it's thinking about stuff like that where if you take a macroeconomic perspective of the market rather than just maybe company focused, it might lead you down a certain path and allow you to understand when certain sectors are going to do well. But it also might lead you to a shit path as well, because I thought semiconductors were going to do really, really well this year, just based off of, shortages. And obviously semiconductors in the next 20, 30 years are going to continue to be extremely lucrative to own, because they're in literally everything now. But they can lead you to say, wow, I need to have more semiconductors in my portfolio. And then semiconductors go to trash for the year. So you really have to kind of think, and sometimes you might overthink, and sometimes that might be good, that might be bad, which is another reason why you could always just invest in the S&P 500.
Yeah. Solid. That's like at this point for me, it's just like something I enjoy, So,
So I'm curious, what's your goal? Is it just mass wealth accumulation? Is it dividends?
Yeah, generally just like wealth, I guess. Like the dividends for me, like dividend stocks just, I guess, make more sense to me because, like obviously, in most cases, there's not going to be as much growth, but I don't know. My general thought process is like you're slowly sort of reaping the rewards of your investments like slowly over time. And like if you're focused more on like growth, I guess, or even so, like if you're doing some sort of like swing trade for like a few months or years or something like that, you're still going to have to like sell and sell at the right time and stuff like that. So, I mean, it's definitely a way to go with, buying and selling at different times and stuff like that. But I guess for me, the dividend like concept just kind of clicks for me and really makes sense. I definitely own companies that don't pay dividends, but it's not really my primary focus at this point. And also, like, I definitely have a lot of money just in the S&P 500 or full stock market, so it's not like I'm just going all in stocks. Really, I would say my dividend portfolio at this point is really just like a learning experience. It's not really a substantial portion of my like investments really, but I spend the most time on it because it's like a lot more complex, I guess you could say. And I've definitely learned a lot, which is good, so that when I can actually put a lot more money into it, it's sort of know what I'm doing at that point. So
Yeah, I mean, as a dividend investor, I respect it because initially, as a former like dividend only investor, I will say, I respect it because when I was very much in my infancy in my career, back in 2013 timeframe, and then 2014, I saw a lot of people lose their jobs at the latter half of 2014 and early 2015 because we had a very severe, I don't want to say, basically it went from $80 a barrel down to like $28 a barrel in early 2015. And so with that, I saw a lot of friends and folks lose their jobs. And so I was like, I never want to be caught with my pants down, right? Like my thought process was, I need dividends, I need them now, right? And I need an income stream in case I ever get to the place where I'm unfortunately laid off. And I invested in companies that paid higher dividends, and likely, like you had said, focused on maybe companies that weren't growing as much, but they had a lucrative dividend. And to be fair, it was good with respect to the fact that I was able to invest and I was able to learn something. But one of the things that I did learn was, while I was being prudent about getting money into the market, and I did make money doing it that way, I likely lost out on hundreds of thousands of dollars at this point by not investing in the SP 500 instead. And I'm not saying dividend investing is bad by any means, because had I needed it, things could have gone the other way. It would have been enough for me to make sure that I, had some money to do anything, or, at least had $500 a month coming in here, or $500 a month coming in there. And I would have just need to have found another, gig that paid $500 just to make ends meet versus, but when you luck out, right, and you have a course of, let's say, 10 years of having really good luck, of course, it's going to add up to big numbers. And obviously, we know what tech has done over the past 10 years as well, with Google literally their revenue going up 10x over the past 10 years on a quarterly basis, which is absolutely outstanding. Going from like 6 billion a quarter to like 60 billion a quarter. It's like absurd. But you start to understand, like, at least for me, what your objectives are and for why, rather than just doing it because you think it's appropriate. Like, I respect it, but it truly gave me a different perspective to see both sides of the coin and recognize that I was losing money comparatively to the market, to understand and fully get to the place where I recognize that I was doing myself a disservice. And then two, I have the opportunity to switch to dividends in times of need if I need them, but right now I do not. And so my thought process was kind of flipped a little bit, and it kind of gave me an idea as to being sure that you're investing in things for the right reasons. And I'm not, like I said, I'm not downplaying dividends at all. And in fact, I have a portfolio that I'm going to start for my mother, who's probably going to be very much dividend focused. And I still am a dividend investor at heart, right? That's why I have Pepsi. That's why I have Johnson & Johnson. That's why I have those good quality companies. But what I would have focused on and tried to get into my portfolio earlier was maybe companies that were more dividend growth investing oriented, that were consistently growing the dividend because they have excess cash flows, versus companies that were paying a 10% dividend or a 15% dividend. Or,
Oh yeah, for sure.
because I got caught in that with the first year or two, being like, oh, it's paying 15%. It's got to be good, right? It's got to be juicy. So anyway,
Yeah.
you somebody said this really well on a Twitter space the other day. Well, not the other day. It's probably like 6 months ago now. But they said the market is a learning game, and you will pay. Well, basically, it was like you'll pay your tuition in one way or another, and generally speaking, it's through losses. They said it way better than I just did, but whether that loss is opportunity cost or whether
Yeah.
that loss is true losses, which I think a lot of people have seen over the past 6 months to a year, it's just acknowledging to learn to be slightly humble and think things through rather than being very whimsical and just like
Yeah.
jumping from thing to thing. Because when you jump from thing to thing, sometimes there's a lot of churn, and with churn, there's definitely opportunities for inefficiencies, and with inefficiencies, opportunity for losses.
Yeah. I guess that's sort of like um, part of the focus on dividends at this point for me is like just trying to increase my competency in like one area, before I like start to spread out more, I guess. Try to get like a good handle on what I'm doing there. And then, at other points I can expand and do other things. But um, if that makes sense, kind of focus on things.
Makes perfect sense. Yeah, trust me, it makes great sense because literally every time I walk into a room, I know for a fact I'm the least intelligent person in it. And so it just makes me just try to think, as hard as my little brain can to get as big brain of an outcome as I can. And what I recognize is if you kind of just rush through things, like you said, like you'll kind of get maybe a rash decision. And with the rash decisions, unfortunately, you lose.
Yeah.
But it is nice. So when you're thinking about before you move into something, or when you're talking about that, do you mean like a competitive edge where you think you can say get more alpha or return than say somebody else, or do you mean just in order to develop a skill before you maybe get ahead of yourself and avoid losing money?
Yeah, probably the latter, like just developing a specific like knowledge set, because I would say like generally, well, I guess I don't know if you would say this for sure, but like investing in companies, I guess more so as dividend companies, value companies, like dividend growth type companies, it's going to be like a different mindset, I guess, and different thought processes per se than if you're investing in like something like Palantir or something a little bit more speculative per se. So at this point, it's just kind of like becoming more comfortable with those dividend stocks and like um, continuing to educate myself in those areas. And once I feel a little bit more comfortable with that, probably then kind of expanding into other areas, um, like some more speculative things or like just other styles of companies, I guess. And
Mm-hmm.
one thing I guess I kind of want to do better too is like have more knowledge of like companies that I am not invested in, so that like if there is some opportunity there, it's I can kind of jump on it a little bit without being rash per se, because I'll kind of already be prepared, because sometimes that's something I notice, like if a, there's a company like some sort of dividend company out there or just a company in general that I'm not invested in, I won't pay much attention to it, and then it will not like crash per se, but be at a lower price, and I'll be thinking, well, that sort of looks like a good price to me, but at this point I'm not very knowledgeable about that company, so I don't really feel comfortable investing at this point. And so if I was more prepared, I guess then I would be able to take advantage of that more. So
Mm-hmm. Yeah, I mean, the thing that I always think about, this is more of a recent thing that I've been thinking about lately, but companies didn't go public for us to make money. They went public for themselves to make money. So they could either fuel another stage of development or so that the co-founder could sell out of shares or what have you. Or the banks just begged them to go public. One of the three. So the way that I kind of look at it is like I shouldn't invest in all the companies. I should invest in the ones that are performing well. And I think what ends up happening is because somebody sees a company doing X on the market and it's there that they need to invest. And I think it's more like you need to do a sense check, like you're saying, and being prudent about like, do they kind of meet my thresholds and do they kind of meet what I'm looking for in an organization? And do I align appropriately with their values before I actually dip my toes into it? So you can't, that's the way, like if you do it well, you can't lose money, right? Of course, over the course of the long term, you can always lose money in a month or 2 years. But if you're investing in 10 years time and you kind of know what you're doing a little bit, and you're not being stupid with your money, I don't think you'll lose money per se. There's always the possibility, but um, yeah, I think it's a very noble goal. But you kind of introduce also the fact that how much time it takes to get knowledgeable about all these companies too.
Yeah.
Which maybe not everyone want. Like you said early on, it's a hobby for you, so you don't necessarily mind.
Yeah,
But
exactly.
other people might, right? And so that kind of goes back to like, not saying you're wrong, but it's right for you because you love it, and I'm the same way, right? Like I don't mind, listening to an earnings call and being like, man, this CEO really, he has some real gravitas, right? Like he's able to really get people engaged and really knows what's going on, versus like other people might be like, man, I got to listen to this damn earnings report. Like I don't give a shit. Like just give me my money, and so there's something to be said about where you are in your investing career, and also how involved you want to be, how active or
Yeah.
passive you want to be.
That sort of brings up something I was actually going to ask you about. Like, what do you like have a strategy or like a thought process for like I guess like evaluating the sort of leadership team of a company, or sort of thinking about that? Because I guess I would say like when I started investing, um, I didn't really, not that I didn't think the like leadership, I guess like the people at the top were very important, but I was just like, it's just a few people, and I didn't really think they could have much impact. But I would say my thought process on that has definitely changed a lot. I guess I think part of it definitely is like working, I guess, for companies myself and sort of seeing how that can work. But I've definitely shifted my thoughts there. So, but I don't really like know, I guess, how to evaluate that very well. Like, is there anything you have there?
Yes, I have a very philosophical soapbox that I can get on top of briefly here. So when I was first entering the workforce, back in 2012, 2013, my thought process aligned very heavily with dividend investing and being like, you know what? Focus needs to be on operating margins and making sure that we're cutting costs in anywhere that we can. And, you know, management needs to be speaking about that every damn earnings report and stuff of the like, right? But what I've come to realize as of late is what companies truly accelerate in the environment that we're in today. Maybe it's because money's cheap. Maybe it's because I don't know. But I think instead of being a money driven organization, what you need is a financially savvy group of individuals that have a purpose-led organization. And what I mean by purpose-led is Apple's not out there being like, we're going to make a shit ton of money. Apple's out there saying, we want to make sure that we have a high quality product that teachers can use to be able to help teach students, that people that are making music can make quality music. And that's the goal. And at the end of the day, they end up bringing in a crap ton of money. And same thing with Microsoft. Microsoft wants to provide great enterprise products. And with that, they provide cloud services and what have you. Amazon, great example, is not necessarily a company that focuses on profitability, but focuses on making sure they're able to get the customer the products that they deserve in the shortest amount of time possible and make them as happy as possible, right? Amazon, I'm sure, can raise prime rates by an expansive amount and shit money like it's no tomorrow. But at the end of the day, they favor being able to grow their infrastructure, grow their influence, however you see fit, and do it slowly over time. And those are the companies that I feel end up doing way better in the long term. They might not necessarily make great moves and strides in the first place, but you look at companies like Costco, you look at companies like, and I think to be a prime example of this, I think Microsoft is a really good example, because you had somebody who was looking to innovate and create PCs and create enterprise software from its foundation and its founding, which was Bill Gates, and it transferred to Ballmer, who only was looking at the dollars and cents. And it didn't by any means get Microsoft anywhere close to bankruptcy, but it let them be passed by something like an Apple, where Apple was then able to create and innovate these great products. And then Microsoft was playing catch up. Microsoft was like, oh, we need to come out, with the Zune, and basically we have to come out with the Surface Pro to combat with tablets, and they just were kind of playing catch up. And it wasn't until Satya Nadella really started getting into cloud services and where the enterprises really wanted to get to, that it truly kind of got back to where Microsoft is today, which is growing revenue like crazy. And you can see what it's done to the share price. Yeah. And so it makes me fearful a little bit of some of these dividend companies where you continue to not innovate. I think it's prudent of, say, Philip Morris to look at IQOS, to look at what's the next step beyond smoking, quit old smoking, right? And be able to create products that can move into the next century. I think it's innovative and prudent of them to diversify with the high cash margins that they have in, say, the cigarette business that they have, by other businesses that can innovate, right? Obviously, people like smoking tobacco, they're going to smoke tobacco, but you can invest in other companies that can innovate, like healthcare companies, which is exactly what they're trying to do in the UK. So I look for more of that in companies now, which is quality products, innovation, and focus on making sure that the business plays the long game, which the long game is continuing to stay in business, right? And that's the game that everyone's trying to play. Business is like not a finite game, it's an infinite game. Yeah. And so Simon Sinek says that perfectly. And so if you're focusing on the dollars and cents, eventually somebody's going to come out with a better product that's eventually going to put you out of business. And so the thought process is, how can you continue to grow and innovate in order to continue to play the game? And that's kind of what I focus on a little bit more so now, which is why I've started to invest in the Googles and the Amazons and the Palantirs. Whereas 2.5, 3 years ago, you wouldn't have found one of those in my portfolio.
Okay, that makes sense. I guess one more question. Someone actually asked in the chat about like pipeline companies, oil pipeline companies, going back to oil. What do you think of those? I guess they gave the specific examples of ENB and EPD.
I know EPD.
Do you know anything about them?
ENB, is that Edbridge, I guess?
Yeah, I think so.
So they're more cash flow companies, but they're debt vehicles, right? So I think EPD and EPD are master limited partnerships. So the taxes are passed on through the shareholders. So just be cautious with that. But one thing I would look for specifically for those companies, I don't know off the top of my head, but what I will say is, if you were to invest in a pipeline company, be sure to look at how much debt they have. Are they good enough in terms of their discounted cash flow to be able to pay for, or distributable cash flow to be able to pay a decent dividend if that's what you're in it for, and also to maintain their interest payments, which will be high because of the fact that they have so much debt. But also consider what environment we're getting into. It's been okay for those pipeline companies to get further debt lately. But if we're able to stay in this high interest rate environment, future debt will be much more expensive for them to maintain going. And let's just say if we stay at this, 10-year treasury rate for, the next 3-4 years, and as debt rolls off over the next 5 to 10 years, it might be very difficult for them to be able to, or potentially difficult, because I don't know the exact cash flow coming from those companies, for them to maintain some of that debt. And with that, are they going to have to start selling off assets? And also just kind of make sure that with the assets that they are in, I'm assuming most of them are U.S. and Canadian pipeline companies, are the areas that they're in growing production, because pipelines don't get paid off of the oil price. They get paid off of how many barrels go through the pipeline and how many millions of cubic feet go through the pipeline. So if they're in a production declining area, like let's just say the Bakken, which is kind of at its peak, the most money they're going to make today is, kind of what it's going to be. And it's only going to decline from the Bakken here on out. Whereas the Permian's still being established, right? They're still building pipelines for the Permian, which is West Texas, and the DJ Basin, which is like, I guess, more Colorado area. But yeah, so that's kind of the way I look at it, is like, understand what business you're getting into when you're investing in that company. And when you're investing in the pipeline business, you're investing in volume, not the dollar price of oil. And that's the key things I would look at. I don't know. I think that they've run up a little bit for Enbridge, if I remember correctly. But I know Kyle from Passive Income Investor, I think, just bought Enbridge. So who's to say it's not going to be good? So yeah, that's kind of my thoughts on pipelines, personally.
All right. Sounds good. I guess the last thing we'll talk about is like, do you have any specific like goals, I guess, with your investments? What's the ultimate goal there?
Dividends wise, it's like 120,000 ish a year in dividends. Long-term portfolio wise, it's more of establishing other avenues of like real estate and other businesses, so I could potentially have the optionality of leaving my job within the next couple of years. And I have some minor businesses that do okay, but nothing at the moment that sustains a salary like I do get paid for my 9 to 5 right now. So it's okay to juggle both. But the long-term aspect of the portfolio has kind of gotten to me wanting to get to about 10 million. So it's an approximate 10x from where I'm at today. And the hope is I'd be able to get there by 40. But I know, that being said, it wouldn't be portfolio driven alone. It would have to be through creating a business or doing other things on top of it. And I know if I were to just invest and invest only, 10 million with inflation and 10 million with, time, would be able to get there. But the thought process is, for me right now, is try to get there by 40. So the thought process is I'm going to have to create some sort of business in order to get there.
Okay.
Yeah.
Cool. All right. Is there anything else you want to talk about?
No, man. Much appreciated. I got jealous that you hadn't asked me to get on yet. So, and I was giving you crap, I think, when you're talking to GW or something. But much appreciated that you finally had me on. And we do streams ourselves on Friday nights. So if you ever feel interested to hop on and just get a different perspective, or try to field questions from Kyle, because him and I have differing opinions on what a good investment is sometimes, more than happy to have you on. But otherwise, good luck and continued success with what you're doing, man. And keep fighting the good fight, and hopefully I'll be able to connect up with you in the next couple of months.
All right. Cool.
Yeah.
Thank you very much.
Yeah, man.
You
Cheers,
too.
brother.
See ya.
Cheers.